Wall Street Week with Rukeyser is made possible by the financial support of viewers like you. By the Travelers, insurance and related financial services working to provide financial peace of mind for American business. By Enron, providing natural gas which holds the promise for a cleaner world and a more energy-independent America. Enron Corp. And the Enron Foundation. And by Prudential Bates Securities. Rock solid. Market wise. Produced Friday, December 28. Our panelists are Ralph Acampora, James Grant, Lewis Holland, and Martin Zweig.
Good evening, I'm Louis Rukeyser. This is Wall Street Week. Welcome back. And don't worry, folks, nobody died. And we're not even in mourning for the U.S. economy. We're just all gussied up like this for a happy event. Our 21st annual New Year's party. The mildly historic occasion on which we look back on the year just past, such as it was, and then in our perennial triumph of hope over experience, try to figure out where we go from here. Now, 21 years used to be the test of adulthood in America. And so you might think that after all the marvelous advice we've given in that time to the nation's political, economic, and financial leaders, they would have begun to display at least some signs of maturity in 1990. Alas, it appears that we're going to have to keep on plugging. Politically, George Bush showed just how addictive that Washington air can be when he was talked by congressional snake oil artists into abandoning his greatest asset, his pledge of no new taxes, in return for a so-called budget deal that, it's now already abundantly clear, won't cut the deficit, but will further slow down an already gasping economy in 1991. We'll give poor George our 1990 Bay of Pigs Award. Economically, the grand poobahs of the Federal Reserve spent the year so preoccupied with reminiscences of the last economic wars that they forgot to fight the new one and waited till the economy was certifiably inert before beginning to loosen their lengthy stranglehold on credit. We'll give them our 1990 Rip Van Winkle Award. Financially, the nation's bank regulators, terrified of being called to appear before a congressional committee and made to hear the terrible letters S and L, foolishly scared bankers out of making even good productive loans that could have kept the economy chugging along, and they thereby helped create what is now an all but official national recession. We'll give these guys our 1990 Every Vegetable Isn't Broccoli Award. All this and Milli Vanilli, too. Not to mention Saddam Hussein. Was there then nothing good to report in 1990? Not on your tintype. Economically, all we've really proved is that no politician in either party has been able to repeal the business cycle. And that, as we've often noted here, the easiest prediction for any economist to make any time is that we're going to have another recession, because eventually we always do. Before this one arrived, however, we had managed to complete in 1990 the longest peacetime economic expansion in the history of the Republic, to witness a spectacular new boom in American exports, to bring the average guy's real income to its highest level ever, and to find paying jobs for a record number and a record percentage of the American people. Those records, I suspect, will look impressive long after the currently fashionable trashing of the 1980s has been consigned to the intellectual dump heap to which it belongs. Financially, what can we find in the way of good news? Well, it's perfectly true that stocks were down this year as America's confidence generally drooped, but there's more than a straw's worth of cheer in noting that the S&P 500 had gone 8 straight years without a decline, the longest winning streak in the history of investing, and that in that period it had nearly tripled, even before you calculate the dividends those stocks kept paying. In that context, this year's decline of just 7%, and about half that amount if you figure in dividends, merely proves that stocks do fluctuate, surprise, surprise, and that those who have bought and held quality stocks are still faring far better than those who were frightened away in panic in 1982 and 1987. But could even Pollyanna find anything good to report on the political scene in 1990? You betcha. not one candidate in either party announced his candidacy for President of the United States. It's a modern first, and I think we should enjoy it while we can. But first, let's take a look at what happened in Wall Street in the last full week of 1990. And the answer is mighty little. In the slowest trading in 5 years, the Dow Jones Industrial Average took its first loss in 5 weeks, off about 4.5 points at 2629.21. And all the broader indexes also failed to share the Christmas spirit. One chief elf moved. Alan Shaw switched from neutral to negative on the technical outlook for the next 6 months, leaving our elves index in dead, if not comatose, neutral. Each year in this program, we conduct for your benefit what is almost certainly the single toughest competition in the world of investing. We ask each of our panelists to submit a specific list of where he or she thinks you should put your money in the year ahead. And then we don't let them change a thing for 12 months. Come hell high, water, or Saddam Hussein. Yet, believe it or not, when we opened the time capsules tonight, we found that a bunch of the panelists, including all 4 of those here this evening, would actually have made you money even in the ultra-difficult year of 1990. But don't worry, all you Marquis de Sade fans out there, I'll find other things to whip them for before the evening's out. First, though, let's note that every bear has his day, and that after years of growling to an unheeding world, Jim Grant has had his in 1990. So let's begin by asking Jim whether he is at all disconcerted by the recent comebacks in both the bond and stock markets.
Oh, no. I mean, things, as you note, will fluctuate. And I'm not sure we're through with our business, which is the unraveling of some of the things that you also mentioned.
We'll be talking in greater length about some of them later on, but to what extent do you think this market is a hostage to the Middle East situation?
Almost not at all. I think that is almost the least of the worries. I think it's hostage, in fact, to the legacy of the 80s, or some of that legacy. The 80s was greater than one could have thought because of things like bank credit and debt, and I think the 90s will be a little worse.
And 1991, specifically, we're going to keep paying for some of those financial weaknesses that we've...
I think so. I don't mean to sound as if there were Calvinist justice to be meted out, but I think there have been objective excesses, and these will be wrung out.
Ralph Acampora, you're more cheerful than Jim. You, in fact, are currently among the 3 optimistic elves. Why are you suddenly turning optimistic? Because, in fact, you thought we'd be even lower than we eventually got by this time.
Well, it's not a sudden thing, Lou. I turned optimistic about 2 months ago, and partly due to the fact that I think a lot of the excesses that we're talking about are already in the market, whether it's the Mideast, whether it's the banking problems. I just think the market, as a discounting mechanism, has done a very, very good job, and I see no real big downside from here.
Well, let's just pursue the point Jim raised. Certainly, anyone who looks at this economy has to be concerned about the debt that's built up. Why is that not an overhanging threat?
Well, it is, and I think there will be periodic, there will be times that we will have periodic weakness because of these problems. But, you know, I like to just say that all of this concern is nothing new. I mean, it's been around for a while now, and the Dow's still above 2,600. So I think the Dow's putting in a pretty good show for itself.
Lou Holland, the market has taken a beating because of these things, but it's had a good accounting, Ralph says. Do you agree?
I think so. I think that from here, though, it's going to be a little bit more difficult, and that I think the recession is going to be worse than the consensus. We've had 11% rally so far off the bottom in the middle of October, since the middle of October. And I suspect that we're going to have tough sledding as we get into January, when, in fact, the fourth quarter earnings reports start to appear. So I think it's possible we can work our way higher here, but certainly because of the earnings situation, and obviously if we have any shooting in the Middle East, that's likely to slow things down also.
Marty, Lou is the only one who seems to think, other than myself, that the Middle East is a big factor here. Is that one of the things on your mind?
I think the Middle East is a wild card because anything can happen. A war could go badly, oil prices could go up, the market could get slaughtered, or we could win right away, or even have a peaceful solution, and oil could go down and the market could go up. And I don't want to bet on something that I can't judge. So I'm trying to eliminate the Middle East as a real thing for me to invest on one way or the other here.
Do you think the market has been having a bear market rally and it's nearing the point of exhaustion?
I think there's a chance, maybe 15% or so, that we've actually seen the bottom and it could be a new bull market, which leaves 85% that is still a bear market rally. A lot depends on the recession. If it's a normal post-war recession, that ends in a few months from now, we've probably seen the bottom, but I don't really believe that myself. I think the recession will be deeper.
We'll settle all that for good later in this program. But meanwhile, before we look ahead with these eminent panelists, let's review where we've been in a year that saw new records in the blue chip averages as recently as July, but then underwent a distinct chill in the Arabian desert night. Even at the end, the bluer the chip, the less the pain. The Dow ended up losing only 4.5%, but the damage was greater in the broader indexes. And we may have to find another word for the so-called precious metals, which continued to tarnish as silver dropped to levels it hadn't seen since the mid-70s. The U.S. dollar held its own against the currency of our neighbor to the north, but sagged further against the Japanese yen, despite a 40% fall in Tokyo stocks, and fell even more precipitately against the major European currencies. Meanwhile, the U.S. economy had a sluggish year that, most people are now convinced, marked the end of the longest peacetime expansion in American history. The recession is not yet official because the economy continued to move forward, however listlessly, in each of the first 3 quarters. The shorthand definition of a recession is 2 consecutive quarters in which total national output declines. Current numbers suggest that that's now just a matter of time. Inflation reared its bloated head again this year, pumped up by rising oil prices. For the 12 months ending in November, consumer prices rose 6.3%, the fastest pace in 8.5 years. Unemployment, which reached a 16-year low in 1989 at 5%, has lately been creeping up, reaching 5.9% last month. As for short-term interest rates, the benchmark prime has been stuck at 10% since the first week of 1990, the longest it has remained unchanged in more than 25 years, though the banks are now under pressure to follow the Federal Reserve's lead toward lower rates. Long-term bond yields had 2 spikes above 9% this year as inflation fears grew, but of late have been coming down. Today's yield on Standard & Poor's index of long-term Treasury bonds is just under 8.5%, still a bit above their level at the end of 1989. And here's the villain of the autumnal inflation scenario, the world oil price. The price of a barrel of oil on the New York futures market had tumbled to just above $15 on June 20th, a 2-year low. But the oil price took off like a scared camel after Saddam Hussein invaded Kuwait, peaking at an all-time high above $41 a barrel in October before beginning to fall again to today's price of $27.57. The soaring cost of oil imports reversed a heartening 2-year decline in the nation's trade deficit. While the total for the first 10 months of this year was slightly lower than that for the comparable period a year ago, the full 1990 figures are expected to show an increase in the deficit. Incidentally, the nation has not seen a monthly trade surplus since April of 1976. And where do we go from here? The Commerce Department's index of so-called leading economic indicators has been falling for 5 straight months. 3 in a row is often considered enough to be a precursor of recession, so the message from these numbers is undeniably sobering. Jim Grant, which of these numbers, if any, is the one to watch for the 1991 markets?
I think the number to watch is the money rate the Germans pay on Deutschmarks, of all things. The bank in Germany, the Bundesbank, is the last bastion of credit in a world in which credit is greatly troubled. If the Germans become Bakerized, that is, if their central bank capitulates to the trend, which is towards discredit rather than credit, I think that there will be a number of big changes in the investment world.
And would they be good or bad for the U.S. if they loosen in Germany?
Well, I think it'll be great for gold. Gold will be the thing to own. I think it might be good short-term for our currency.
Ralph, what do you think?
Well, I think the number I look at most carefully, economic number, would be domestic interest rates. I think the Federal Reserve has no choice but to lower rates. And I think that will ripple effect through our stock market and our bond market. And that's one of the reasons why I think